Welcome back to the exchange. The Dow closed above 45,000 yesterday. 19% gain year to date, not too shabby. But my next guest just posted a 32% return for his fund in its fiscal year. It was their best year ever, in fact. Joining me is Jay Bowen. He's the president and chief investment officer of Bowen, Haynes & Company. They are the sole manager of the Tampa Firefighters and Police Officers Pension Fund. And his winning strategy avoids alternative investments like hedge funds and private equity and focuses exclusively on high-quality equity and fixed income securities. Did I get that right?
You got it right.
Wow.
And I'm glad that you said unconventional. A few minutes ago, we actually view ourselves as being conventionally unconventional or unconventionally conventional. Really,
kind of like old school.
Yeah, right.
You know, so, I mean, I've read institutions and pension funds that could have 40% of their assets in private equity and hedge funds and things like that. Was this a decision? Now, your dad managed the fund for a couple decades before you did.
Right.
Who made the decision along the way? Was it a moment in time when you said we're not doing alternatives, or did it kind of over the years you always just deflect the opportunity?
It somewhat evolved, and initially it was a kind of a situation where we're dealing with basically taxpayer money, and we wanted to really err on the side of being conservative and quality-oriented, and there was just a lot of unknowns, particularly 20, 30 years ago, about that space. Then it became apparent about 20 years ago that we are able to play those markets through the public markets. One of our biggest holdings is Blackstone,
I see.
which is the largest private equity fund in the world.
Oh, that's so interesting. So what you
from a
did,
liquidity standpoint and interest rate risk standpoint, we don't have to delve into these corners of the
not just that, but you're eating their cooking. Like, in other words, instead of worrying about their portfolio, you know, or co-investing in those types of accounts, you're just investing in the asset manager themselves. Right,
and the same can be said for other, what used to be alternatives. Now, real estate, for instance, you can go into the highly liquid REIT arena, and you can be in and out in seconds if you need to be, relative to how it was 20, 30 years ago when they really were alternatives. I mean, you had to own outside of the public markets. So that's a big change that's happened.
So now we're in 2024, where it's been an everything go up kind of year. How do you position the portfolio for, you know, you're already in the middle of your fiscal year, but basically for 2025? Right.
We're very long-term oriented. We like to look at the fund in 20-year increments.
Wow.
We now can show 31 separate 20-year increments.
Wow.
First one, 1974 to 1994, and then on up. This reminds me, has a latter part of the 90s feel to me, when you had that was the last authentic soft landing. You also had a lot of high-tech innovation and risk-taking and entrepreneurship. You had animal spirits coming back in. And you had, this is very important because it's an authentic silver bullet to the economy, you had a great burst in productivity growth.
Absolutely.
And we've seen that the last 3 or 4 quarters where productivity is trending back up 2.5%, 3% range after being very, for the last really 10 years, really under the norm. If that happens, that's really good for overall living standards, for profits margins, the economy, earnings. I think that we're headed for that era.
If you're wondering why we're watching Elon Musk right now, with, I think, one of his children on his shoulders, we're going to hear from him, from Vivek Ramaswamy, and from Mike Johnson, the Speaker of the House, for their Department of Government Efficiency. They're going to hold a press conference here in a couple of moments' time. So there he was making his way over to that. These don't sound like the matters that you need to be concerned by, or maybe they are. Maybe the deficit is one.
But that ties into another one of our themes. I think that we're going to be stunned over the next couple of years. And it really turns to a couple of Supreme Court decisions, but the overturning that Chevron doctrine, that is an act of economic liberation, I think. And part of the reason we're bullish looking out is on the regulation side, we're going to have really significant deregulation, and it's going to be flowing from this new group that's focused, the efficiency group.
If I could, so what you're saying is, I think, going to be reassuring. So at the start of the hour, we were hearing from a couple of managers with great experience, been in this market a long time, say things look a little frothy. I might expect someone like you, who's been able to kind of look through these trends, get to the heart of things, to say the same thing. And instead, I'm hearing from you a lot of optimism that maybe the stock market can continue going higher for the next, you know, I don't want to call it 6 months, but maybe that kind of medium to longer term period of time, despite valuations being where they are right now.
Yeah, I think we're going to continue to normalize pre-great financial crisis, normalize from a nominal real growth standpoint, nominal growth standpoint, interest rate standpoint.
But how can that be when the population trends are what they are, and there are factors that, you know, kind of working against that?
This high-tech innovation is so interesting and important, along with productivity growth, that I think there's going to be a dynamism introduced back into the economy that we haven't seen in quite a while. A lot of new business startups, just because of what's unfolding on the policy front, regulatory policy, tax policy. I think we're destined for higher real growth and nominal growth. Looking out, now I do think we're going to have a lot more volatility.
Okay.
More 5 to 10% pullbacks along the way that we've seen.